Hello everyone, welcome to Keystone Academia. Today we'll be discussing the financial analysis of Cewmlator. So firstly, before starting, we need to understand why financial analysis is important. So technically, this is the pre-seen for November 25 and Feb 26. So financial analysis gives us a background of the pre-seen. For example, what profit we have, how much we did last year, how much we did this year, and comparison with our competitors. So basically, this numbers can help us to recommend the financial strategy sometimes. Let's say funding options. So if you're going with debt, how much retained earnings we have, or maybe a dividend strategy, how much dividend we paid, or collaterals for debt options. Technically, they are not expecting you to remember all the numbers. If you can use certain numbers to justify, that is fine. But it's not hard and fast that you should know numbers, you should do all the ratios. If you're doing ratios, it's well and good, and that too for our understanding, not for the examination. It's very rare that you have to talk about the ratios. Certain ratios which are important can be gearing ratio. We can talk about. We can see about the dividend percentage, then the retained earnings, growth in retained earnings, then gain or loss in the foreign exchange, the translation risk we can talk about. Okay, so let's get started. So what we'll be focusing here is the income statement, balance sheet, cash flow statement, what they have given, how it affects the stakeholders, and the trend. Obviously, the share price is also part of it. Let's see. So if we see year-on-year comparison in Dutchlandian dollar, consolidated profit and loss, that should be in billion actually, not million. So if you see from 2024 to 25, we have an increase of almost 6.4%. It was 31 billion, now it has gone to 38 billion. So that is a benefit. If we see overall in the industry also, there's a growth, and we can compare this with our competitors also. So that means that industry is doing good. Then cost of goods sold has come down. This is a positive side for us, maybe because of automation. Sometime what happened, we would have increase our non-current asset. We have increase in our automation and all. So that means the cost of goods have come down. But again, there is no clarity. It is all assumption. Maybe we can do a cross check. If our non-current asset has gone up, like here, yes, it has gone up 2.5%. It was 25 billion. Now it is 27.5. So maybe this money of 2.5 billion we might have used in automation or some other technologies that might have helped us to reduce the cost of goods sold. But again, it's not exactly the same thing. But overall, the industry is growing. They have also given us for the competitors. So for the competitor, is just to compare. You don't need to go in detail. Remember their numbers. So we have a competitor called Atom here. So Atom, if we see from 36.5 billion, they have gone up to 41.9 billion. 5%, 5.4%. Overall, they are also growing. So technically, their profit has also gone up. We see that the financials are positive. The company is growing. It's on the right track. Okay. So maybe this number you can use, or you can just say, from 2024, 25, we have seen a growth, and maybe the same trend of around 6% can grow in the next year of 2026. This revenue growth can be because of increased sales, or we have launched new products, or sometime we have just changed the pricing. But due to pricing, it's rare that in 1 year we have changed almost 6.4% of pricing. Then gross profit obviously has gone up. So gross profit is important. Then selling and administration expenses come down. So this is a very good thing. Maybe you can use this to highlight the efficiency, what efficiency and effectiveness we have achieved. Cost of goods sold have gone down despite the revenue goes up. Otherwise, the revenue will mostly increase the cost of goods sold. And then same thing with the selling and admin. Research, if you are looking at research research expenses has increased. So technically, it's a good thing, but if you can reduce the cost, maybe that can help. Operating profit is very important because the banks, the finance cost here, if you talk about, they are looking at interest coverage, how many times they're covering the interest. So operating profit has gone up, that is benefit. This is positive in the future if you want to go for debt options. So we can comply with the covenants. Pre-tax profit is 4 billion, tax expense, then profit is 3.1 billion. That's a massive increase from 1.2 billion to 3.1 billion. So good job with a lot of things. Overall, we are into a very stable position. So this can be a opportunity for us to grow in the market or grow with our products. There is a high possibility a question can come up that we are going for a growth opportunity because this is a right time. We are not struggling financially. In fact, later on we'll see the share price. In share price also we are doing pretty good. So these points is just for analysis. You are not hard and fast to remember. Some of the points as an overview you should know about. So what does this increase in revenue says that revenue surged by 6.4 billion, indicating strong market traction or pricing power. Gross profit rose 47.6%, outpacing revenue growth, suggest improved cost efficiency and product mix. So it's a good thing for us. Operating profit nearly doubled. It's a very, very good sign. It's very rare company like us, which is, number 3 in the world. And that too is very close to first and second. We are among the top companies in the world and our operating profit is coming to almost double. That is a significance, significant improvement. Net profit also jumped by 158%. Cost structures 30% but slower than the revenue. Selling and admin R&D cost rose modestly. Finance cost up by 6.7%. Why it has gone up the finance cost here? If you see 1.5 to it has gone 1.6 billion. We can see the difference that the property, plant and equipment has gone up. Maybe we have used this, we have taken loan in the start of the year or the end of next year and end of, after the end of the previous financial year. And we have used that money to invest in the PP, the non-current asset. Tax obviously is fixed, what we are doing. Highlights worth noting. Maybe this point you can remember. Just to recall again, you don't have any calculation in the exam. So these points are mostly to justify the points. So margin expansion across all levels, gross, operating and net margins improved significantly. Revenue growth outpaced cost inflation, driving strong profitability. So if we continue like this, definitely we have a good future. R&D investment scaled with top line. Top line is revenue, bottom line is profit. Finance and tax cost also rose. So we need to see how we can reduce the finance cost. Maybe taking more debt but taking debt again, the finance will go up. But at least on the tax part, or if we can use transfer pricing or other options. But remember, it should be an ethical approach. And if you look at the financial position, or we can call it balance sheet, changes are important. Therefore, they give 2 years. So from 25 billion it has gone to 27.5 billion. This is the reason, or this is a strong reason which I believe. Therefore, the finance cost has gone up. 10% increase. Goodwill has remained the same. Goodwill is important for our business. Remember, goodwill also get amortized. Just like the asset having depreciation, goodwill also get amortized. So we have maintained, maybe some new have come up. So that's the reason. Other intangible asset has gone up. This is extremely important for our business, goodwill and intangible asset. The growth in intangible, let's say patents, we have got in new design, new licenses, everything can be part of intangible assets. So this need to grow, then only the business can grow. And maybe this has shown up in our sales already. Till now, we don't see any major problem in the finance. In fact, everything looks positive. So total non-current asset is 40.2 billion. Inventory is 5.3. What can be the inventory? Obviously, unfinished goods what we have, or maybe work in progress. It has gone up. This may be because of the future project we are doing, or the future sales we have, or the prediction we have. So usually in car industry now, if you come out of electric vehicles, they use a just-in-time approach. What is just-in-time approach? It's a pull approach. Customer will first book the cars, then will make it available. But now in EVs, what is happening? If you look at real world company BYD also, they are manufacturing in bulk so that the cost can come down. So if the cost is coming down, Then from pull approach, we are moving to push. Push means we have car ready. We need buyers for that. So maybe that is the reason the inventory can go up. But again, looking at our numbers, it's not that massive. But if you do too much of this to reduce the cost, the benefit is reduced cost. So we can have better margin. But the downside is we can have unfinished vehicles, or we can say unsold vehicles rather than unfinished, half finished or unsold vehicles. That can be a problem. And that is the problem BYD is already facing. They have so much of unsold cars. Trade receivables has gone up. This usually can be from B2B sales. We might have corporates who are buying on bulk. So usually B2B, business to business, is in credit. This might be the reason. However, we need to make sure that receivable doesn't go up too much, because it can affect our cash flow. It can affect our working capital. Cash at bank has increased. So cash at bank is 3.7 billion. That is a very big amount. To be honest, if any acquisition or any financing options come, this can be the first option. However, don't recommend to use all this 3.7 billion, because we need to keep it for our working capital or any other emergency. And remember, this bank or cash at bank as 3.7 billion, this is the only money we have. What they do in the retained earnings or what we have seen in the profit, that is not actually equal to cash. Profit is not equal to cash, right? Retained earning is not equal to cash, because we use accrual based accounting, and because of accounting principle, uh, that is not actual what we have. But this 3.7 billion is actually what we have. So the total asset is coming to 52.5 billion. That is a good number. Now, if you look at share capital, so we have 5 billion of share capital. So if you do, let's say we have done share for share exchange for acquisition, so share capital will go up. Currency reserves, as we have international operations, we need to keep currency reserves. This has also gone up. So it depends on the business, where the business is coming from, which you don't have an exact idea. Retained earning has gone up. Obviously, we have added a good profit this time. So retained earnings again can be used, but remember, this is not equal to cash. Total equity here is 28.7. Now moving on to the borrowings. If we see non-current liabilities, borrowing is 20 billion. It was 18.5 and we have taken another 1.5 billion. And that's the reason our finance cost has gone up. And as discussed, this money might have used for raising or in the non-current assets. Trade payables have also gone up. So if you see, receivables have gone up and payables as well. So we might be also doing in credit. It's normal, because we are buying from other businesses. We have vendors, we have suppliers. Like say we are producing our own batteries. So we have this lithium mining companies. So they are the one managing uh, our supply. So maybe they are one of the payables for us, or we might have other vendors, technology provider. We might have outsourced certain service, isn't it? So many things. Tax liability is one. So we have already paid tax. What is this tax? It may be indirect taxes or other liability which we have to pay. Then total current liabilities is 3.8. Total liability is 23.8. So technically 52.5. That is balancing. Now if you compare to the previous one, everything has gone up, but overall looks positive. What you need to remember, that PP increased by 10%. Other intangible also gone up. Goodwill remain unchanged. Strategic insight, if you see, maybe what you want to use in your answers. The growth in PP suggests capital investment, possibly expansion, modernization, or capital capacity increase. This may support long-term revenue growth or operational efficiency. What is happening in this industry, again, if you go back to Tesla or BYD, the industry leaders, they are using robotics, they are using a lot of automation to manufacture the car. For example, BYD, in one of the documentary, they are mentioning that in 1 minute they'll have two cars ready, like 30 seconds per car. And obviously it's not humanly possible to come up with that accuracy in 30 seconds. So it's machine that is doing. So for machine, we need to invest a lot, at least in the start. Then slowly we can get the return out of that. The increase in intangible asset could indicate investment in R&D, software, patents, or licensing. signaling innovation or digital transformation. Stable goodwill suggests to new acquisitions the company likely forced to internal growth. What recommendation we can do? Monitoring ROI on new fixed and intangible asset investment ensure capital projects are delivering value or competitive advantage. Inventory we need to see. Having too much inventory can be a problem for working capital. Or maybe this just increased because of sale, or we are expecting, or we have done some analysis for the next year's sale or the coming months. Therefore, we have increased our inventory. Receivables we need to manage. Sometimes it can be done by giving them discount or better pricing or having a strict contracts. Cash and equivalent is also the same points here. The rise in inventory could imply anticipation of demand, slower sales or overstocking. That is a risk. Receivables. If you're talking about the receivables, outpacing revenue assumed could indicate relaxed credit terms or delayed collections, a potential liquidity concern. Increase in cash signals improve liquidity or cautious capital allocation. What we can recommend here from here? Optimize inventory turnover to prevent holding costs. Reduce. Maybe this point you can remember. These are all analysis. This point you can use in your answers. Strengthen credit control policies to reduce days sales outstanding. Evaluate cash deployment for growth or shareholder returns, reinvestment, dividends, debt repayment. If we talk about the equity has gone up. Currency reserve has also gone up. Share capital unchanged. High retained earnings because of the profit, obviously. Reflects strong profitability and earnings retention, potentially driven by operational performance or cost control. Yes, it is actually because of that the COGS have gone down, cost of goods sold, as we have seen, and even the admin expenses have gone down. The increase in currency reserves might reflect gains from foreign operations or fixed hedging, indicating exposure to global market. Stable share capital suggests no new equity was issued to sign off a self-funded growth. That means we have not used retained earnings. So this point is again important to remember. Maybe if you want to answer, funding options and you are in favor of equity. So you can say last year we have taken debt of 1.5 billion, which has increased our debt. Why not go with equity? Because we have not used in the last year. Recommendations: consider capital return strategies, example dividend or share buyback, if no high yield investment opportunity exists. Maintain foreign exchange risk monitoring strategies if currency reserves continue to rise. Borrowing we need to see this 1.5 billion. It can have effect on our working capital again. Why? Because the finance cost has gone up. Overall, the interest turnover is good, but it can affect in the future. Let's say we are not able to maintain the revenues or the cost of goods sold, but this is a fixed expense, isn't it? And mostly this should be a long-term borrowing. Strategy recommendations: ensure new debt is matched with income generating asset, or we can say short-term income generating asset. Debt sustainability, especially if interest rate rise or cash flow tightens. Current liabilities: trade payable increased by 0.3 billion, tax liability increased by 0.6 billion. Obviously, it is head to the business. What can the payable might include? Strong supply relationship and extended credit terms. Maybe we can acquire them as well. Again, going back to BYD and Tesla, both of them, they have controlled the ecosystem. In fact, BYD is coming up with a very big factory in China. I think in Xinjiang, someplace. It is like a city. Everything they want in house, everything A to Z. So that can be a strategy for us. We can also start acquiring our small suppliers. Maybe not small in size, big as well, because we have a good finance support. We are a listed company. We have good uh, retained earnings, good profit. Another reason can be delayed payments due to liquidity constraint. The sharp increase in tax liabilities suggests higher taxable profit, but could also point deferred tax settlements or timing differences. Because when we are closing and all of this. Strategic recommendation: monitoring working capital cycles, optimize payables without straining supplier relationships. Assess tax planning efficiency and ensure compliance to avoid penalties. Penalties is financials, is finance. It's not only about the financials anymore. It is about reputational risk. That also we need to consider. Recommendation is here, but you don't need to do the same. This is just for understand. Maintain a balancing capital structure, track returns on equity, return asset. So we give positive signals. Now, if you go to change in equity, here it's important. Like for example, we have given 12.9% of profit as dividend. Firstly, opening balance of share capital is 5 billion. We have seen currency reserves is gain. Technically, this gain and loss is mostly a translation. It's not an actual gain or loss. Retained earnings plus profit is our closing balance. But from the profit, we have given the dividend. Technically, our retained earnings 22.3 billion. Total, if we see, it is 28.7. But again, it's theoretical. One of the thing theoretical, as you can see, is 0.3 billion. This 30 million, whatever is called 0.3 billion, that is on paper. And 12.9% we have given as a dividend. Now, how much dividend to give? For that, we need to look at industry. We have discussed this point in industry analysis also. For example, Tesla is not in favor of paying a dividend currently. BYD is, I think, paying single digit or a little bit higher than that. So we need to see all these points to be considered. A dividend policy question can come up. Let's say we need money. So what we can do next year, will not pay this 0.4 billion or will not pay this 12, 13%. We'll give a zero dividend, or we can give them a free cash, free share, sorry, and use that money for investment. But honestly, I don't think we should do that, because looking at the numbers, we are in good position and 0.4 billion should not make a major difference. The company has played it smart so far. We are very smart with our numbers. We have not paid 20, 30, 40, 50%. There was a pre-seen last time, we have paid 89% and our competitor paid 90% dividend. Technically, we didn't have any money, right? And if you compare this with our competitors, they have paid 0.3 billion out of their 2.4 profit. So very similar number of dividend they have given. But obviously their profit was 2.4, little bit less, but overall their retained earning is higher than us because they have bigger revenue and they must be slightly bigger than us as well. If you see their share capital, it's 8 billion, ours is 5. You don't need to worry about their numbers. It is just for comparison now. You just need to know your numbers. Maybe for comparison, you can sometime in dividend and all you can say. Rest all is just for comparison. If they are also growing, we are also growing, that means the industry is growing. Let's say if they are not growing, Atom and only our business simulator is growing, that means the business is in our favor. If both are growing, means the industry itself is growing. It's not saturated. Key points. Overall payout in the industry is low. Why it is low? Because banks are not very happy to give debt here. Why? Because it's very risky business. Secondly, the requirement of money is too high. Maybe banks can give the same amount of money to other industries. Let's say healthcare, construction. So many are there where they can get better results, better returns, more guaranteed returns at a lower risk, because banks by default are risk averse, isn't it? They have to look at their profits. And at this level, we can't expect the VCs and everything to come up with the money. Venture capitalists and all, they work with the startups. They don't have this much money. We need in billions. So very big corporations can only come and help us. It is a risk, or it's a risky for financial institution to provide funding. Hence, companies use retained earning as primary source. So I think we should continue like this. Unless you have a better point, you can justify it. Make sure in exam you have to justify. Considering the lesser profit, 12.9 to 12.5%. So see very similar dividend. How much we paid? 12.9. How much they paid? 12.5. Considering the lesser profit made by Atom Group, the payout remains the same. Investigating reasons for this will enhance understanding and aid in repositioning of Cewmlator. We can investigate, but the information is very low. we can just assume it's an industry standard. And the problem here is we don't have an idea how much it was paid the last year. They give other numbers, but they don't give about the dividend. Maybe we have given similar last year and we continued like this. We have a link here where you can go and check how much dividend is being paid in different companies in our industry. Okay, so if you click on this link, it will take you there. Now coming to the Atom Group financial statements. So we can just go quickly here. Their revenue is quite big compared to us, 36.5 billion. They have last year and this year it was 41.9. 5.4 billion. We have got 6 plus. But again, looking at the revenue, if you compare to our revenue, exactly, if I go back for a minute, it is 38.2. So if we just put it as 38 as a round figure, and here if you look 41, almost 42. So 4 billion difference is there, or 3.8 we can say. So they are bigger than us. So having these two companies in the same country, I'm just thinking, which country it is. It's very difficult to put it in a real scenario because BYD is in China, Tesla is in US. So in the real world, we don't have one country where we have two big companies who are dominating the EV industries. Because it sounds very theoretical. But anyways, it's a fictional scenario, so we don't need to worry about it. Cost of goods sold for them has gone up. For us, it has come down. So that is the benefit thing. Gross profit, obviously. Selling and admin expenses slightly gone up. So they have also controlled here very well. Research expense is common for the business and industry, I believe. So it will go up. Finance cost for them also has gone up. Finance cost and their interest cover ratio also looks good, almost like 5 by 2, if you say 2.5 times. It's really good. Maybe they have also invested in the PP. Let's see quickly. Yes, 30.2 to 33.2. But again, it's not obvious. Maybe some acquisition have happened and they have taken the debt, and we might have done the same. It is just an assumption. And PP might have increased property, plant, and equipment, maybe because we have revalued our asset. There can be other reasons. So ultimately, the profit is 2.4. But what is not so favorable for Atom is, despite having a bigger revenue, their profit has been lesser than us. And why? Because they are not able to control the cost of goods sold. Revenue is 14%, gross profit margin, control operating expenses, very similar. If we go, maybe you can go through this point also. Significant operating leverage, demonstrate profit scales will well with the revenue. They won't ask you in the exam, this is just for understanding. Slight increase reflects higher borrowing, tax expenses has gone up as well. But focus more on our business. You can ignore all this detail for this also, no problem. Just look at the overview. However, both the companies are in a very strong financial position. Accelerated profit growth, effective cost control, smart investment in R&D, sustainable revenue growth. It looks like it will continue to grow. Coming back to the statement of financial position or balance sheet, if we see 3 billion, they have gone up in the PP. Goodwill remains same. Other intangibles have gone up. Very, very similar to us. To be honest, it looks like our business model is exactly the same, and maybe we are operating in the same countries internationally also. We are based out of Duxland, but maybe the international operation is very similar as well. To be honest, now merger and acquisition with both these companies is almost impossible. Why? Because it will create a monopoly and the government won't allow us. So instead of fighting with Atom as a competitor, maybe we can compete, but we should partner. If we partner, both of our cost in the research can come down. For example, here if you see, the research for them is 3.1 billion, and for us also it has gone up. So why can't we work with some partnership while maintaining the confidentiality? There's a bigger risk of confidentiality. Our research cost can be reduced. Or otherwise, instead, if you're not comfortable to work with Atom, we can go with the university. So we have a lot of board of directors. I think 3 board of directors who are directly, indirectly associated with the university. So we can do a strategic partnership with the capital city university or any other university in Duxland or maybe internationally also. Looking at the current asset inventory has gone up for them. Trade receivable has gone up. Bank 4.1 billion. They also have good amount of money to invest. Let's say if we are trying to buy a company and there is a bidding happening, bidding is going to happen. So they also have good amount of money. We should know what the competitors will pay them. So we need to be very careful. If we don't take a good deal, then Atom will buy it. Share capital remains the same. That means they have also not taken, rights issue and all from the last year. Currency reserve has gone up. This is again the translation part, we can say. Return earning has gone up because of profit, total equity. Borrowing has gone up because obviously the loan. We discussed this. Payables, receivable payables are going up. Very similar business model. Tax liability has gone up. Total current liability is 3.8, non-current plus current is 28.8, and we are balancing it by 62.1 billion. Compared to 2024, we have a better numbers in 2025. I know this is a lot of information what you see on the screen. Honestly, I'm not expecting you to know all of this. This is just for understanding. Even if you want to remember, first prioritize our company. This is just an extra analysis because as a tutor, as a institute, we need to go in depth. Okay. Therefore, we have done it. Don't get overwhelmed with the information. So total asset grew by 11.3. That means the company is in expansion phase. So we need to know what the competitors are doing. For example, we have one concept in E3 like prisoner's dilemma, or we can uh, call it to understand what the competitors are doing. So if we know the numbers, if we know what they are going through, then we can have an idea. If you do expand, they are also expanding. If you do acquisition, they can also do the acquisition. So they are good financially. They can always copy a strategy for their favor. So we need to be very mindful if you want to dominate them. If they are able to dominate to our strategy, then we are going towards failure, right? Increase in PP 3 billion. Indicate capacity building strategy to support higher output or modernization. Maybe the same thing we have also done it. I think the insight remains very much similar. What else we can look at here? So here the first point, prisoner's dilemma, you're getting confused. It is we have another word also for that. We call it game theory. We have to understand what the competitors are doing. Okay. Then current ratio remains 3:6:1, receivable inventory. Equity increased by 8.5. Currency reserve 0.5 billion. Long-term debt rose. Overall, very good position, very similar to us. Maintain excellent liquidity. Liquidity is very important. Strong earnings momentum. The business maintain a sustained financial structure with long-term stability. Company is positioned for sustainable expansion, innovation, and value creation. You can look at the difference, some of the points total liability. This is again an extra analysis. Mostly you have to look at the banks, how much money they have, maybe the equity part. That's it. Some of the ratios which you can look at. Current asset, if you see cumulative is 12.1, Atom is 13.6. It's better to know our ratio, some of that. Like if you look at Cewmlator is 3.16, we have formula also here, debt to equity is 0.70. So technically we are using debt divided by debt plus equity. Then it will be around 41%. But you can use this formula also, debt by equity direct. But remember, whatever you use the same. Let's say in the first paragraph, you are saying 70% gearing. Then in the second paragraph, you are saying 41.9% or around 42%. Don't confuse the exam. But very similar gearing also. Cash ratio, if you see like 0.79, Atom is 1.08. differentiation point, the same thing, you can go through it. Okay, maybe this point we can quickly look at it. How can Cewmlator compete more effectively? So this is in our favor. What we can do, target income growth via sector aligning acquisition. So one thing that can help us or that is required for us is acquisition. Introduce receivable acceleration to reduce that receivable days, and if possible delay the payable days so we have better working. Maintain margin discipline, avoid debt funding expansion unless we are getting good returns. Relocate towards productive fixed asset or IP back revenue stream, intellectual property, because in this industry that is important. Launch cost to cash programs and jurisdiction tax optimization. See how we can save on the tax. This will help in boosting retained earnings and cash flow as well. Another thing what we can do is lock in lower rates, extended maturities. Long term loan if you take, maybe we can get a better deal. Or sometime we can tie up with the professionals or we can say consultants who can negotiate on our behalf to get a better deal. Introduce AI-led demand planning, so we'll have less inventory. License underutilized tech assets. Instead of buying this, license it. Evaluate cost, cross-border tax credits. We can get some tax credit because we are sustainable. Renegotiate supplier contracts. These are basic things, but if we improve, let's say 1% in 5 areas, so we are getting 5% more margin, 5% more profit. That is a massive increase, isn't it? So Cewmlator's edge lies in strong interest cover and discipline leverage. To match items, scale and liquidity, Cewmlator should expand selectively, optimize working capital, and monetize investment. However, if we see Atom is bigger than us, they have bigger revenue, they have bigger share capital, so their valuation of a business will be higher than us. So we have to compete, we have to outgrow them. This moves will fortify covenant buffers, enhance investor confidence, and position Cewmlator for strategic part. Okay. Now what we can do is I'll quickly take you to the share price. Just give me 1 second. All right. I hope you are able to see a different screen here. So these are share price is also part of financials. Technically, as a shareholders, the earnings depend on two areas. What is that? First is dividend, which we have done like 12.9%. Second is increase in share price. So overall, if you see from 2020 till 2025, September 25, we have closed the year. It has gone up. It was 40, around 40. Now it has touched around 105, or let's say even 100. That is 2.5 times. That is a decent growth or more than a decent growth. But as we see in this, every second year, there is a massive dip. We are 105 or 10 year, and we have come down to, we're doing really good here, but it came down to like 50, we can say, approximate. Then again, we touch 100, we came back to 60. Again, we touch 100 plus, we came back to less than 60. And now this trend was again not very good. Now we are here. So I'm just thinking, what if we go down like this? There can be a scenario because that is what is happening here. If you see, there's a lot of ups and downs. But again, looking at the sales, looking at what competitors are doing, we are positive. And we don't have any information for the competitors, what they have done in the share price. But I believe their share price should be very similar. Now we have accumulated beta of 0.56. So what is beta? Beta is technically the risk factor. Imagine if it is 1. 1 means we have the same risk as the competitors. But 0.56, the competitors or industry. Industry is a better word. 0.56 means we are 44%. 1 minus 0.56, like 44, right? So we are 44% less risky than the industry. That means we are a good option for the investors, good options for the shareholders. So this can work in our favor if we want to raise money through the shareholder. We have some points. The share price approximately $105 at the moment. This coincided with the peak in 2021. The gradual reach of previous peak point after decline in prices is indicate that company is performing well and meeting expectational stakeholders. There are major appointments of the board also made in 2020 to 25. Maybe that is one of the reasons. But overall, it's going good. But the problem is there's a massive difference, 100 to coming to 60. Some of the small changes here, maybe because we have done rights issue and share price have fall down, but that can be 10-20%. But this may be because of external reasons. Okay, so that's it from the financials. However, we have not discussed the news articles in our previous, so we can just do that. So our analysis will be completed. So technically, we have three part in the pre-seen analysis. We have done part one, where we have talked about the summary. Part two, we have discussed the remaining pre-seen, and this is the part three. This is core on financials and the news articles. Okay, so what is news stories? News stories is technically focusing on to give us an extra information as a reader, because we have students who are also attempting this. We are very senior people, so CIMA goes with basic. They have started a comic part also here, where they are putting a small kid just as a fictional one to ask something, and they are giving us some information. Then, like traditional pre-seen, they also have a news article. News article can be, some news is in favor of our industry, some news can be against our industry. So we need to see whether it is an opportunity or a threat. Let's quickly go through this. What are batteries in an electric car? It depends on the type of electric car. Batteries, electric car BEV, need to have very big batteries because they are totally depend upon battery power. This is what we do primarily, isn't it? This is a simulator's business. The battery in most BEVs built into floor underneath the seat. In most BEVs, the battery consists of 800 individual cells that are held inside sealed box. The cells are connected together so that they can all be charged simultaneously or used to power the car's motor or motors. Why it is important? This is the reason where the recycling becomes difficult, because underneath. So now technology is working, especially with the scooters. They have detachable batteries. So if the battery is completely drained, they can remove the battery and put the new one. So what will happen? The charging time will be saved. If it is like this, we have to keep it overnight 6 hours, 8 hours to charge, and that is a major problem for the buyer. The sealed box makes it impossible to see the batteries. It is sealed because the batteries create a voltage of at least 400 volts, which is high enough to be dangerous if the batteries are handled carelessly without the correct equipment. It can cause fire. Second one, NOAA age 11. How do rechargeable batteries work? All batteries consist of three basic parts: two metal electrodes and the cathode and the anode. Technically, it is the basic how the any battery works. And a liquid or paste called the electrolyte, which separates two electrodes connecting the cathode and the anode from the outside of the battery. Perhaps switching on the power in electric car cause a flow of electrons, which just another term of electricity. You don't need to worry about this. Very basic. The external flow of electrons is driven by a flow of positively charged ions from the anode to cathode. The ions are created by a chemical reaction inside battery and they flow through it. The chemical reaction continues until they no longer create and accept the positive ions. Anyways, this is nothing to remember for the exam. Rechargeable batteries can be restored by applying a voltage to the cathode and anode that reverse the flow and recharge the battery. This is about recharge. This is a little bit technical, but they won't ask, how the charging works. You're not an electric engineer. You're a finance professional, so you don't need to worry about it. And we have one more here. Is it true that EVs are faster than ICE cars? So this is interesting. It is true that some EVs are faster than ICE. If you see why, Tesla Cybertruck was so famous, because it has a lot of features that the normal ICE cars also doesn't have. That is partly because the way that electric motors perform compared to petrol and diesel. Electric motors can produce a lot of torque even at low speed. That give us one opportunity. Why don't we have like speed cars? Why don't we have like like Formula One cars, race cars? We can think of that like a niche product. Maybe it can help us in marketing also. It means that BVs can accelerate rapidly even from a standstill. ICE cars depend a lot on changing gears to get them started and to accelerate to their top speed. PHEVs are drivers. It offers drivers a choice between electric and petrol or diesel, but most PHEVs can use both at once, which gives really powerful combination. The performance of all modern cars, whether ICE or EV, is controlled by computers that manage the amount of power that is available to driver. These computers are called electronic control units or ECUs. Most cars could be even faster if the software in the ECUs could be tweaked or altered. So this software cybersecurity is very important. Let's say we have put a speed limit and there is hacking happen and people are going it all way, which is not safe, but we don't have the design which is safe enough at that speed. We tweaking the ECUs to increase the power available to cars drive would increase the fuel consumption of ICE cars and reduce the range of EVs. Technically, the range will get affected with the speed. Then we have one more, I think the last one of the comic. The satellite navigation system in my mom's car warns her about the problems such as traffic jams on the road ahead. How does her car know the road is busy? This is more about the technology we can put into the car, I believe. When a mom bought the car, she almost certainly linked her smartphone to the car's wireless Bluetooth system. The connection has a number of uses. The connection enables the car to receive update about traffic, condition on the road ahead, enabling the Stanley to recommend more efficient routes that will get her to her destination quickly and safe. Car manufacturer also use these connections to update the software. So we need a car which is very much updated, which is, but the problem is in ICE car, they still need batteries to manage all of this. But now on the same battery, we are running the car and we need to run all this music system and this technology, maps, front camera, back camera, and so many more things. That manages the car system, such as engine or electric motor. The car manufacturers might wish to change the software to improve car's performance, perhaps improving the efficiency of the motor in EV. That is range is extended. Technically, it will affect the range. That's the main thing. And we need to constantly update. This also gives an hint that we need good IT people to work in our business. These updates are downloaded while the car is being driven, but they are not processed until the car has stopped and been switched off. Most modern cars are in frequent communication with manufacturers' data centers, either receiving information such as traffic reports you ask about or transmitting information such as frequency, duration of journeys. So this can help us as a manufacturer also to track the data and see what is happening. We can understand on normal days how much people drive, or if we have like 100 cars, for example, we can see what majority of the people is daily mileage, daily how much they are driving. This can help us to do the range. We have one more. What happens to old EVs? Are they recycled to make new cars? Sadly, it is difficult to recycle EVs. ICE cars contain a great deal of iron and steel that can be recycled very easily. So the part of ICE cars can be, the steel and everything can be recycled. But ICE cars is easy because they are more heavy and they have the strict. But if you see EVs, usually it is a plastic or electronic waste which is very difficult to recycle. Why want to have this plastics? Because we want it to be lighter. Because if it is heavier, like the ICE car, imagine we have EVs that have this iron steel. So what will happen? The battery life will reduce, isn't it? The range will reduce. Far worse than that, the batteries in electric cars are made from a variety of metals such as nickel, cobalt, and lithium that can be difficult to recover. This is unfortunate because the growing population or popularity of EVs might lead to a scarcity of these metals. Or another reason we can say is it's not profitable. So therefore, companies are not doing that. It's a loss. There's also an environmental concern. This gives us a hint why it can be an exam question. The manufacturer of an EV is responsible for far more emissions than the manufacturer of ICE cars, largely because of the batteries. This is a very important line. We are saying that we are environmentally friendly, but what about this? Though we are not, mining and all, but the lithium mining process and the entire supply chain has a lot of problem with the environment, lot of emission. Battery is responsible for 45% of emission from EVs manufacture, and that is part that is most difficult to resolve. So this, article give us a hint. There can be a question on the environmental part. It is possible to recover metals, including nickel and cobalt, from old EV batteries by heating them to temperature of 1600 degrees Celsius. So we have opportunity to recycle, but it has a lot of infrastructure need, lot of technical people, and technically maybe motivation, and motivation will come if companies are making profit out of that, or maybe the government should take the initiative. Both of this doesn't look an option in the near future, or at least on this 1 or 2 year. Unfortunately, that destroys the lithium in the batteries in addition to consuming a significant amount of energy. Alternatively, it is possible to recover the lithium by crushing old batteries and treating the resulting mass with chemical solvents. Unfortunately, the crushing process uses a great deal of energy and the solvents are highly toxic, which can create environmental problems when they are disposed of after the lithium has been extracted. So maybe we need better technology in this to recycle. Now let's go to the news article, the last part. Duxland Daily. Local governments reluctant to commit to the installation of public EV charging points. This point we have discussed in industry analysis also, if you remember. So in industry, the biggest problem is charging stations. Many motorists are reluctant to switch from cars with ICE engines to EVs because concern about range. BEVs and PHEVs, when using battery power and the ability of charging points when the batteries require top up, many motorists cannot install charger by their home. So we don't have the charging infrastructure. Imagine if we solve this problem. I believe that, when I say I believe, it is from the industry, this is a major problem. So we can believe that we can have a great range. Let's say we have increased sale by 6-7% this time, or 10%. Maybe it can 20%, 25%, maybe 50%. At least for a few years we can see that. And that has happened in China. If it's in China, the overall cars, almost 65% of the cars are EVs, if my research was correct. And if you look at the new cars, almost 80% plus, or around 85%, I read somewhere, is new car is electric. But if you see in other countries, like if you look at in India, it's around 10% or less. In Africa, it's less than 1%. In US, it's around 12-13%. Why? The infrastructure is the thing. And company like us, Cewmlator, we cannot go and install everywhere. So maybe we need to come as an industry altogether, or we need to partner with the government. We need to partner with the shopping areas, like we have Walmart, we have Costco, we have Aldi, companies like this. It's already under process, but need to be done at a very large scale. And another problem is the top up. What you're saying about top up is 20 minutes, 30 minutes, but usually this charging takes hours. So we need better batteries, better chargers. Now BYD is promising they'll come up with a charger and a battery which can be done in less than 30 minutes. If that is possible, or even if somebody can get 50%, 25% in 30 minutes, people can do that. But imagine to wait for an hour, nobody has that amount of time. It creates a lot of inconvenience. It's very inconvenient. Some drivers are keen to encourage the local government responsible for the service in their towns and cities to provide charging points. Maybe government can come up, like in London, the local municipality, they have taken electric cars, they have bought cars from BYD. So governments overall, not only in London, you can see in India and majority countries, when they're even in US, when they're buying new buses for public transport, they are going electric. And they have the funds, they have the infrastructure to do the recharge. And the bus obviously is so big, it will have a bigger range. But obviously the power requirement is higher. So what we can see as a business, we can go into product development, go into this buses where we can have government as a stakeholder, then influence them to come up with the infrastructure. We have one NED also coming from this background. They argue that the cost of doing so would not be excessive because it is possible to buy and install a domestic charger in a drive or garage for $1,500. Sadly, the cost of rapid charger that is sufficiently robust for use of public is rather more than that. They have given the numbers also. Charging unit 15,000, installation permits. Technically, it takes $60,000. Assume this is like 60,000 US dollar. And who will pay for it? If customers have to pay every time, it's a problem. And again, if it is a heavy amount, they won't pay. So we need to create a win-win situation which is not costing high for the customers. It may be some time before there is a public charging point at the end of the year of your street. Remember, they have bought this car because it should be cheaper than the ICE cars. That's what we promised them. That's daily. Should you worry about battery degradation in your EVs? One of the features of rechargeable battery is that their ability to hold a charge degrades over time. That is true for all rechargeable batteries, including those in mobile phones and laptop communications. If you use scooters, and you have seen that. I experienced myself. I have an electric scooter, and within 3 months, the battery is almost like 50% gone now. I used to drive it so much. Now it is not trustworthy. But the battery of that was not that good quality. But in cars, it is better, but still it will go down. But it's particular concern for the owners of electric vehicles. The most obvious sign of degradation is that cars range decrease as it gets older. So obviously we cannot detach the battery, and this give us a major problem. What is a major problem here? They have not mentioned here, but I am thinking is about recycling. Or if it is not recycling, it's about reselling. If you have a Toyota car, let's say we have used 20 years, also people are ready to buy. 10 years, people are happy to pay you good amount. Any other cars, ICE engine. Resale market is there. But here we don't have a resale market as well. And if you see, the range is decreasing with the time. But degradation can also lead to longer charging times. Replacement batteries can cost $20,000 or more, almost like half of the cost car price, which is a concern for owners. It may be more cost effective to scrap an EV that is otherwise in good condition than replace its battery. Manufacturers guarantees the batteries in their EVs. The terms of those guarantees vary between manufacturers, but most agree to replace the battery if the EV's range decreased by 30% or more within the 8 years of ownership. So technically, Tesla is also doing same around that time. That says that degradation could be a problem for many owners. But at least if we say 30%, if we say 8 years, we are giving them some trust. But despite the guarantee, these issues can have. For example, a new Atom Slice, who is Atom Slice? Our competitor's car has range of 280 kilometers, but that could decrease to as little as 196, from 280 to 196, almost 85 kilometers. Let's say 50 miles it has come down without being eligible for a replacement under guarantee. The range could decrease even further after the 8-year guarantee period. So if 85 is gone, we are still not giving anything to them. This can be a problem. Right? Now, if you go to the last page, where should you recharge your EVs? Now, the communities are coming up, at least information if we give to our customers, that can also help. So this is related to that. It's like an education from the Duxland Daily, a local newspaper. There are almost 80,000 EVs charging points in Duxland, but they're owned and operated by 12 different companies. Some of these specialize on-street charging in residential areas to cater EV owners who cannot install charging points at home. Other focus on motorway service stations to attract motorists who are on long journeys. Some have nationwide coverage across Duxland, while others prefer to have a regional presence. So these 12 companies should be our strategic partners. Okay, make sure this is part of our stakeholder list. They have high interest and high power. They can be key players, or maybe we can say, particularly in Cewmlator, our business Cewmlator, whatever you call, we can say medium interest and medium power. If you wish to use any given company's charging points, then all you have to do is visit its website and create an account. That will require you to put your credit card details so that the company can take the payment of for any electricity that you use, but the system are secure, so you should be safe. But the problem is the cost. If it is again expensive, and the location, the cost and the location, the convenience. People need convenience and the cost both. If it is just convenience, but the cost is too high, only in emergency people will use. If it is not convenience, very cheap, sometime people can travel that much. Once registered, you can download the company's app into a smartphone, which will enable you to scan the QR code on any of the company's charging points. Scan the QR code activates the charging point, allowing you to plug in your card and recharge battery. Payment will be taken from credit card automatically when you unplug your card. So technically, it's like making an account, which is very common nowadays. No human intervention. You can register with as many of these companies as you wish, and you can download multiple apps. It might be excessive to have all 12, but there is nothing to prevent that if you wish to have access to them. Or maybe, customers, as per their geography, they can use. There is no fees for having account. The companies have different pricing structure. Pricing in city centers tend to be lower because of competition, while those on motorways, technically the highways, tend to be higher because drivers will pay more to be sure of completing their journeys. But honestly, a lot of drivers are scared to go on motorways. But if they have to, they will check whether there's a charging station. So we can keep it on busy roads like airport or entering into the city, exit of the city. All right. So that's it from this. So we have covered the pre-seen, the financials and everything. So if you have any question, you can always reach out to us. Thank you so much. All the very best.